Hey everybody, it's Brian Shannon here. Today is Saturday. It's the 31st of August 2013, and we did finish this month with losses for the average equity index ETF here. You can see the S&P 500 was down 3% for the month. Nasdaq down about 0.5%. Semis got hit pretty hard, 3.8%, and financials really hit the hardest here of 5%. And this week, obviously, we had the brunt of that selling, really, but we're still holding on to good year-to-date gains. So let's take a look at the charts and see where we are and where we have the potential to go, etc. We've seen that the market this week, again, had a difficult S&P 500 down 1.78%, and the market now, when we look here at the daily chart, we're seeing this pattern of lower highs and lower lows. We had seen this head and shoulders pattern here before with this prior support at 168 broken quite definitively. We rallied up to just below that here in the last week and a half, and obviously found resistance just ahead of that. And we are back below a declining 5-day moving average with lower highs and lower lows. When we take a look at the Fibonacci that we've been looking at off of the lows from June to the July highs, actually August highs, we're right at a 50% retracement right now. It wouldn't surprise me to see us come down to the 61.8% retracement, which gets us about 161.5, and that is really approximately where we see this this trend line from the lows of the fourth quarter in 2012. So it seems like 161 is reasonable for this market, and there's no reason to think that it will hold. For now, it's just a potential level of support. What we're looking at is a market that's guilty till proven innocent. We have a declining 5-day moving average. It looked as though earlier in the week we might get a rally, but then as it broke back down below this prior little resistance area, then we had that gap lower, and obviously all bets to the upside are off. We have declining 5-day moving average. It's no different when we have this environment. It's no different than the weatherman saying we have, a 60 or 70% chance of rain. You would grab your umbrella if you heard that. And for the S&P 500, it looks like there's still a good probability of continued downside. So we have to be defensive here in this market. The Nasdaq is really a little bit more neutral on the daily chart. If we take a look at what we've kind of been doing, it looked as though maybe it was going to hold above that 76 level, but we got back down, and now that 76 is back to an important area of resistance. That is, if we can get back above and hold above that 76 and a quarter, perhaps this market won't sell off further, but it seems as though the buyers had their chance, and now next week, if we're back below 75, it seems to me as though we should continue to decline further to a minimum of that 74 level. If we take a look at the longer term trend, we can see that 74 has been an important area. If we take a look at the trend line from the lows of last year, the fourth quarter, that would get us down to about 72. And if we take some Fibonacci off of these recent lows as well, that is again the June lows, that will get us down, 61.8% retracement will get us down to towards that 72 level. So it's not unreasonable to think that it could be headed down towards 72. We do have to be very cautious in this environment. If somehow the market gets back above and holds back above 76.5 probably, then it's going to look like a more neutral event. And we do have a rising 50-day moving average, so it's not real clear that we should just rush out and short this market aggressively. The Russell 2000 broke that important support at 103, and what we saw was a return move up to that level. So here on the weekly chart, we can still see we're clearly in an uptrend, and that uptrend line that I just drew in takes us from the lows of the fourth quarter last year, and if we were to come down and touch that trend line, we'd come down to about 99.5. And really, if we look again at the Fibonacci here off of the June lows in this recent rally, then we can see that 98.5-ish would be a 2/3 retracement, and it doesn't seem unreasonable to me that we should come down there and test that 100-day moving average. But longer term, we look at the weekly charts, we're still in uptrend Alphatrends in all these markets. If you take a look at the 2011 lows, and I didn't mean to do a Fibonacci, we'll probably be using that at some point in the future. But the S&P 500, the trend line would bring us down to about 155, which is 8 points from here, which is still a decent percentage move. The Nasdaq, we're still clearly in this longer term uptrend as well, and getting down towards 70 would still be held by that trend line. So it's not outright bearish. The semiconductors are really at an important level of prior resistance, or look like they have the potential to drop down towards this 36 level. 36 was an important level of resistance most of 2012 and or all of 2012 and first quarter of this year. When we look at the daily chart, we had seen that 38 level break about 2.5 weeks ago, and now what we're seeing is, well, back to that daily chart, a declining 10, 20, and 50-day moving average. And here's that 36 level where we had tested before. This week we looked like maybe it was going to recover a little bit, briefly poked up above what had been looking like some resistance, but then got smacked right back down, and we gapped lower. We still have a declining 5-day moving average. You can make money, don't get me wrong, you can make money trading these bounces, but the path of least resistance over the intermediate term is still lower with a declining 5-day moving average. And my feeling is when you have a declining 5-day moving average, that your trading ought to be limited to day trades if you're looking to go long. It's just a matter of probabilities. You can make money overnight, but the probabilities aren't as strong. It looks more likely that this market is headed back down towards $36, and this 37 level looks important for now. So we'll see how that is handled early next week. Financials, as we know, they got hit really the hardest last month, down 5%, and last week down 3.09%. So financials are clearly getting some selling in here. If we take a look at the trend line from the fourth quarter of last year, and we could probably even, let's go back a little bit further actually. Let me change the scaling on this weekly chart so we can see it a little bit more clearly. And here's the low from 2011. We can take a trend line that looks like that, or we can take the low from the fourth quarter of last year and see that we're really just kind of flirting with that level here, that we've broken it and we're holding below it for now. The potential levels of support that we were looking at in here don't appear to be holding. If we take a look at that Fibonacci in here as well, the June lows to the recent highs, we're right at that 2/3 retracement. So if this market can turn around in here, it's going to take a little bit of time for that 5-day moving average to flatten out, but we have to be aware we have a declining 10, 20, and that 50-day moving average rolling over as well. So it seems like guilty till proven innocent is still the proper way to approach this, the financials. Maybe if they can get back above and hold above about 1980 next week, then we can break this downtrend line and break this prior support, which seems like it should become resistance. But again, the path of least resistance is lower here in the intermediate term, and that's where you have to honor your timing and your swing trades in here. If you're a longer term investor, it sucks to ride these out, but one possibility for the longer term, by the way, is that this is a left shoulder, this is a head. We're going to come down a little bit further and create a nice bounce, which creates that right shoulder, and we could see that in the S&P 500 as well, that we could see in the Nasdaq, maybe something similar, that we're building the head right now. I don't want to get too far into that scenario because it's really going to take some more time to develop. If we take a look at the home builders, are pretty interesting because they appear to be sitting on some longer term support. If we break this level in here, you got to wonder what a guy like John Paulson is so bullish about in the home building stocks. But 27.5 we're heading down towards, and you can see that we're kind of creating a head and shoulders top in here. Now a lot of times these head and shoulders patterns, will break down below it, it'll reverse back up and then have a powerful squeeze. So be aware of that. Don't just be aware of identifying the textbook pattern. They're good to recognize. There's no danger in knowing what they should do and what they're supposed to do, but they don't always work out the way the plan is. It's no different than, a lot of people criticize technical analysis as perfect at predicting the past. Well, we're not trying to predict. We're trying to look at patterns and say, and and money flows and say, the path of least resistance in these home builders seems to be the money's flowing out. The 10, 20, and 50-day moving average are declining. So on average, there's been sellers in these markets, and it just is pretty stupid to go in there and try to think that you're going to fight all this institutional supply and be the one that can turn it around or pick the low. So it's no different than fundamentals. They predict the past perfectly as well. The market's a discounting mechanism. It discounts the past and anticipates the future. And just as some technical analysis, you have to have your stops because the market won't always do what we hope or expect it to do. Same would be true with the fundamental analysis. I really, I saw someone debating fundamentals and technicals again, and it's really a silly argument. You can use the two to complement each other. Let's take a look at Apple. Apple is, as we know, broken this longer term resistance at about 470, 475, and it did so after that earnings report that came in right here. We had shaken out down below that 400 for a second time, and that volume weight. I'm sorry. Well, we can take a look actually at the volume weighted average price since this low is right at about 460, and since the earnings at about 480. So it'll be interesting to see how that 480 level is handled. Again, let's take a look at the 65-minute time frame because here's where those earnings came. So about 480 is going to be an important level, I think, next week. The path of least resistance in the intermediate term is lower. We do have a declining 5-day moving average. We have prior support that acted as resistance. So a test of 480 seems likely in here, and perhaps this market could even pull back a little bit deeper down towards this prior resistance and that 200-day moving average, which are about 465 to 470. I don't think it would be a bad thing for Apple to continue down towards there and then let these longer-term moving averages flatten out a little bit. We can also take a look here at the TLT, which is the 20-year bond ETF. We're getting a bounce in there, so interest rates are getting a little bit of reprieve this past week. The TLT was actually for the week we saw actually they were down, but for the week they were up 1.63%. I accidentally didn't see that, and it's still red. But we had the bonds come up 1.6%, bringing yields down. We're still in a downtrend with a declining 50-day moving average. So at best we're going to turn sideways in here, but we're still in this longer-term downtrend. And if you look at the weekly chart, this kind of looks to me like a head and shoulders pattern that if you took a measurement, you would say that the high here is about 132 down to the neckline at 112. So that's 20 points from the break of the neckline here of 115. That would give us a price objective down at about 95, and that would obviously be real bad for bond yields. Anyways, the markets are closed on Monday. I hope everyone enjoys their long weekend, and I will talk to you next week. If you're not familiar with Alphatrends, then go take a free trial for a week and come into the chat room, see what we're doing here every day, because we've got a lot of great individual stock ideas that we talk about each day, and a lot of subscribers are doing well in this market.